when I got out of college, I won a Rotary scholarship or fellowship, whatever it was called. It's so long ago, I can hardly remember. But I got, at the tender age of 22 and 23, I got a around the world trip thanks to Rotary. And I spent, a good part of the year I was traveling around the world. I spent a good part of the year in India, which was kind of eye-opening for a young man to see a very different kind of country at that time. What I wanted to talk about today, and I hope it's of interest to many of you, is the stock market. It gets a lot of attention. It seems to me that the stock market, given that we've had an election year, which has not been the friendliest of election years, and we've had a pandemic going on, many people are surprised that the stock market has done as well as it has. I guess one person who wasn't surprised was President Trump, who always took the good stock market as an indication that he was doing a good job. I remember seeing some of his press conferences where the stock market was doing very well after its big tumble in February and March. President Trump would say the market bounced back pretty quickly, and President Trump would say, yeah, that shows what a good job we're doing here. He also predicted that if his opponent, Joe Biden, won the election, that the stock market would crash. And so far, the month of November was one of the best months in recent decades for the stock market. So I guess if President Trump was right that the market would crash if Joe Biden won, maybe we should think that despite what the media are telling us, that maybe Joe Biden didn't win. I don't know. That's supposed to be a joke now. I don't want to get into heavy politics, but anyway, so there's a bit of an explanation that is needed for what the stock market did. And, I have actually been an amateur stock market observer and forecaster for some years. And I sent out to your locale today, to the people in charge of your organization, the Rotary there, and an article, copy of an article from the Wall Street Journal in September 2011. So it's 9+ years ago, I guess, 9 years and October, November, 9 years and 3 months ago. And the article, I'm hoping that if you haven't received it already, that the people who do have it there will forward it to you. But I'll tell you what it was. Basically, the writer for the Wall Street Journal, he's retired now, but his name was E.S. Browning. I don't know why he was always called Jim Browning, but he was one of the fine Wall Street Journal journalists. He knew that in the year 2000, I had predicted that decade from 2000 to 2010 would be a really bad one for the stock market. And so he thought that was interesting. And it turned out that my prediction for 2000 to 2010 was sort of on the mark, or 2000 to 2009, that 10-year period, was on the mark because the market actually had kind of a zero or even a slightly negative return over that decade, and I had sort of predicted that it would have like a zero return. It was just, I'll tell you the nature of the prediction. But so the Wall Street Journal asked me in 2011, and this was after the market had declined a lot during the great financial crisis of 2008, 2009. The market actually hit its bottom in March 2009, but had not recovered all that much by the time the Wall Street Journal interviewed me in 2011. And at that time, the Dow Jones average, this is in the article, and I'm just mentioning it here, the Dow Jones average was slightly under 11,000. And the Standard & Poor's average was about 1,150. Today, the Dow is at around 30,000, and the S&P is around 3,675. So the Dow and the S&P have more or less in the range have tripled since September 2011, roughly speaking. not quite tripled, I guess, in the case of the Dow. So anyway, what did I predict? Well, these predictions are really not sort of predictions. I mean, the Wall Street Journal said, well, okay, since you've called that last decade pretty well, what do you think is going to do in the future? The market will do from 2011 to 2020, and I didn't really use anything other than a simple forecasting method. I said, well, let me just suppose the stock market does as well as it's done historically, that it earns its historically average rate of return from 2011 to 2020. And the numbers I came up with on that basis was that the Dow in 2020, I think the article even says at the end of 2020, the Dow would be 20,250. Whereas actually it's closer to 30,000 right now. And the S&P would be at 2,300 instead of 3,675 where it is now. So obviously I was a terrible forecaster. I should tell you that in 2011, when I give people this forecast, and it's based on studying 230 years of U.S. financial history, where I've watched the ups and downs of the stock market return. There's a sort of little bit of a chart of that in the article. So when you get it, you can take a look at that. Basically, the market was up very high at the end of the 1990s and going into the year 2000. And I noticed historically, whenever the market got to be that high, where its return, a 10-year moving average real return, got to be as high as it was, 17, 18% around the year 2000. That was the height of the dot-com bubble, 1999, 2000. What I noticed that whenever the market got sort of that high, the next decade was pretty bad. It didn't do that well. And so that was the basis of my prediction in 2000, that the decade 2000 to 2009 would be a bad one. And by 2009, of course, we were down to a very low level. And what I noticed from 230 years of history, that whenever the market had a return for a decade that was down that low, the next decade was better. I didn't know how much better it would be. I mean, nobody can really know things like that. I'm waiting for somebody to ask me right now, what's your prediction for the next decade? That's, of course, more interesting than what happened in the past, but the past is certainly a guide to the future. Well, in 2011, the market had really gotten to a very low level. So based on the history of the U.S. stock market, I said, usually when the market gets to that low level, in terms of its return over the previous 10 years, the next decade is better. I didn't know how much better it would be, so I just assumed it would be an average return. And so those numbers that I came up with, 20,250 for the Dow and 2,300 for the S&P, were saying that's where we would be if we had the average long-term return to the stock market. And obviously, I was way too low. I was much too conservative, because the market's done better than that. So the real question is why the market has done so well, and I think that's what I want to get into today. Some people were saying, well, the market recovered from the big drop that occurred in February and March, that the Federal Reserve came in with a very large fiscal stimulus, and the U.S. Treasury mailing out checks, paycheck protection programs, and people got checks in the mail, so the Federal Reserve actually expanded its balance sheet from $4 trillion to $7 trillion, which created a lot of money, created a lot of liquidity that was available in the financial system, and the support it gave to Americans who were out of work, maybe because of the pandemic, shutdowns, things like that. So this fiscal and monetary stimulus might have been one reason why the market recovered, but of course it had been up beyond my projections of 9 years ago, before the pandemic even hit. Some people might say the market is very high. I still hear this today. The Bank for International Settlements, which is sort of a club of central bankers, it's located in Basel, Switzerland. They've come out just this week with a statement that the markets are too high. The world is showing signs of irrational exuberance. So that would be another reason why maybe Americans are just overly optimistic about the future right now. That could be another reason why the stock market's as high as it is. But what I really want to talk about now is, relate the stock market to the levels of interest rates we're having. We are now at the present time and I know a lot about this because I co-authored a book called The History of Interest Rates. We are having the lowest interest rates in all of American history, and probably in pretty much all of world history. And low interest rates are of course, good for the stock market. The stock market is supposed to be a valuation device, and the current price of a stock is supposed to be the present value of all the future payments it will make to you. When you buy a share of stock, you think, well, maybe it'll pay me a dividend, and maybe the price will go up if they reinvest some of their profits. So the price, I'll get two forms of return: a dividend, they might pay me a cash dividend coming along every year, and if they reinvest some of the money instead of paying it all out, which most companies, that's the pattern most companies follow today. There will be a stream of earnings going off into the future, and the sort of fundamental value of a stock is the present value of all those future earnings. How do you get a present value? Well, you discount the future earnings by some sort of discount rate, which is sort of the equivalent of an interest rate. So if interest rates are very low, it makes the value of future earnings higher. And so basically, I think my fundamental reason why the stock market is as high as it is both before and after the pandemic is that we're having these very low interest rates. And there's a question of, well, will they continue? Now, why did I miss my forecast so much between 2011 and 2020? I think it's because I, like most people, having studied the history of interest rates, thought, well, we were at very low interest rates in 2011. The Federal Reserve had fought against the financial crisis by doing a lot of the things it did this year. It expanded its balance sheet a lot, made credit widely available. And so, interest rates were very low then, but most of us thought, based on historical patterns, that they were so low, they would probably normalize. That was the term people use. Interest rates will normalize. And when I thought about what the stock market would do for the last 10 years, I was thinking to myself, well, interest rates will normalize. What does that mean? That means something like interest rates, which were down around, between 0 and 1%, and after the financial crisis would go back up where maybe a 10-year bond, which is what most people look at now, the 10-year Treasury bond, would go back to maybe 3.5%, possibly even 4%. That would be a normal rate. Well, it just happens right now that what I thought of might be a normal rate of 3 to 4% is actually less than 1% right now. If that would be a medium-term Treasury bond, the 10-year bond. They also issue like 30-year bonds, and 30-year bonds. Normally, if the 10-year rate was 3 to 4%, the 30-year bond would have a yield of maybe 4 or 5%, closer to 5%. That's what history would suggest. So, in fact, instead of having a 30-year bond with a yield of, let's say, 4.5 or 5%, right now we have a long-term bond that has a yield of 1.5%. So interest rates are, I would say, the main reason why my forecast, which wasn't really a forecast, it was a mechanical projection of assuming the stock market would only earn its normal average long-term real rate of return for the past decade. I think that the reason I'm so far off, that the market's so much higher than I thought, would be that interest rates are much lower than I and many others thought they would be at this time. Now, the market is high, and by historical standards, one measure of that is what Professor Robert Sylla at Yale calls the CAPE ratio, the cyclically adjusted price earnings ratio, CAPE, cyclically adjusted price earnings ratio. And right now it's about 33. What Sylla does there, he averages everything's done in real terms, so he adjusts for inflation, he adjusts stock prices for inflation, and he adjusts the earnings for inflation. It's the 10-year moving average of returns for the previous 10 years by the that's the denominator. Those are the earnings, and the price, of course, is the current stock market price adjusted for inflation. That happens to be 33 right now. I can tell you that that's about the third highest in history. The other two times when the cyclically adjusted price earnings ratio was this high were in 1929. And you know what happened in 1929. Stocks were very highly priced and they took a big tumble over the next few years. And the other high point that was above where we are now was in the year 2000 at the peak of the dot-com bubble in late 99 and 2000. And this ratio now is 33. In 1929, it was about the same level, about 33, and in the year 2000 was up to 44. So those were the three highest ever CAPE ratios, and in both of the two earlier cases, when the market was this richly valued, it tumbled. There was a crash in 1929, and there was also the crash of the deflation of the dot-com bubble in 2000 to 2002, when the market fell, on the order of 50%. Now, if you believe that, you might want to rush out and sell all your stocks. I'm going to tell you that maybe you shouldn't, because maybe the mistake I made by assuming interest rates would normalize, that's a mistake you're still making. That would be the best argument for thinking that the stock market is overvalued, that interest rates are going to go up. But maybe they aren't going to go up. Since I last talked to you back in, I think it was June, a research paper came out earlier this year, and I've read it, and it's by a young man named Paul Schmelzing. I think he did it in his PhD work at Harvard. And basically, what he did in the paper was to look at the history of interest rates, which I've also looked at, but he dug up a lot more data than I did, and he calculates the real interest rate for 500, 600, 700 years. And the main finding of his paper is that there's been a downtrend of at least 500 to 600 years in the level of interest rates. And he thinks that today's low rates are not something that are unusual or not to be expected. He sort of says that if you look at this long-term trend of interest rates, where we are now is right where we should be. And he also says that rates are probably going to stay this low. Well, the point I would make then, I'm adjusting my thinking now. Instead of thinking interest rates are going to normalize, I'm thinking interest rates are going to stay low for a while. And if real rates stay around zero, or they're probably less than that now, let's say we have 2% inflation and we're slightly under 1% yield on a 10-year treasury bond, that means that the real interest rate now is about minus 1%. It's below zero in real terms. And what that means, we all know that, you buy a treasury bond and it gives you close to 1%, but not quite 1% in yield. But if there's 2% inflation over the year, you're basically losing money. The prices, if you sell your bond a year from now, you can only buy about 99 cents worth of stuff instead of dollars worth right now per unit of the bond value. So if interest rates stay this low, then, I think, let's say interest rates stay around where they are now, and the Fed hits its 2% inflation target going ahead, then $1 of stock earnings with such low interest rates is actually worth more than we thought it was in the past. And so therefore, Schmelzing suggests, and other people have too, that our low interest rates aren't something exceptional that we should look for normalization to occur. In fact, they're going to stay this way for a long time. And the Federal Reserve, at the time it began its massive buying back in March, which ran up its balance sheet from $4 trillion to $7 trillion. The Federal Reserve said, we expect to keep interest rates low for a number of years ahead. So that tells me interest rates are going to stay low. And if that's true, then it's very likely that we have to get used to a new way of valuing stocks, and stocks are really worth more than they were in the past. Let's say the average price earnings ratio for stocks over a long period of time, say the 20th century, even beginning of this century, the average price earnings ratio was like 14 to 16, somewhere in there. And today, I would say, with interest rates as low as they are, maybe we should think that stocks are worth more like 20, maybe even 25 times the earnings. And this is the way I'm explaining to myself and trying to explain to you the seemingly high prices of the stock market now. If you buy my interest rate outlook, there's an adjustment going on that the stock market valuations now and in the future are going to be different from what they were in the past. And we should no longer think that the market is going to go back to its long-term price earnings ratio of, let's say, 15 or 16. It may actually, a normal price earnings ratio may be somewhere between 20 and 25 in the period ahead. Now, how could I be wrong? An economist always likes to think of what will make my forecast go wrong. And I was confessing what made me go wrong in the last 10 years was that interest rates did not normalize. But if I'm predicting now that the current level of stock prices is sustainable into the future, that you shouldn't be holding a lot of cash waiting for the market to fall. That doesn't mean it won't fall. It might, but we could have a new normal of stock prices, which has a higher PE. I could be wrong for 2 or 3 reasons that I'll mention. Saying that stock prices are what some people think they're high now. Maybe they're not really that high. Maybe they're justified. And if interest rates would rise, if you got something back like the normalization that hasn't occurred, if that were to happen, because maybe the Federal Reserve has to fight inflation going down the road, and that's a possibility, I think. If interest rates would rise, then this idea that stocks are actually worth more now than they have been in the past, that would be wrong. So the question is, do you think inflation is going to go up? And if it does, will the Federal Reserve raise interest rates to fight the inflation? That's what it's done at various times in its past history. If that would happen, if interest rates do normalize, then stocks are definitely overvalued now. Another reason why the forecast that these high prices are justified could be wrong is that what we economists call the equity risk premium, how much more you have to pay a person to hold a stock, which fluctuates a lot in value compared to a bond. If the equity risk premium, the sort of higher return you get from the stock market in return for taking higher risk, if that were to rise, then, because the market became very volatile and more risky, that would make the forecast of high stock prices continuing, that could make it wrong. And the third reason, of course, is the stock market is valuing corporate earnings. And corporate earnings have taken a hit because of the pandemic, but certain parts of the economy, the tech, the communications people, we're using Zoom now. Most of us are, I bet you, if you're like me, going back to January, you've never heard the word Zoom. Now we're very familiar with it. A year later, it's a new technology. If you look at the stock of Zoom Communications, I think it's gone up 5 or 6 times this year. And so those corporate earnings have obviously risen. CAT has probably had to pay something to run their Zoom meetings. And that goes to the Zoom company. And other, Facebook and Google and Microsoft, they've all been earning high profits too. If corporate earnings were to fall substantially, then, what the stock market prices would have to fall too, and that could be a reason. But I don't really see corporate earnings, they're depressed a little bit because of the pandemic, but they'll probably recover. And for some companies like Zoom, it's been a boon, actually, not a problem. For their earnings have gone up a lot. So, depending on whether interest rates are going to go up or whether the market becomes so volatile that the equity risk premium rises or corporate profits take a tumble, those are the reasons why my idea that stocks are actually maybe fairly valued now, that's the reasons they could be wrong. So then you have to think about, in your own thinking, you'd have to say, well, is it likely that we're going to have higher inflation and interest rates will go up, or the market becomes more volatile and hence more risky, or that corporate profits go down? I would say that I worry a little bit about the inflation and whether the Fed fights it or not, but I don't really think the market is all that volatile, so that's not a reason for the market to go down. I don't think corporate profits are going to take a tumble. In fact, they'll probably recover as the economy recovers. And another reason, just a folksier way of putting this is one reason the market has gone up is that Ken French up the road. I'm in New Hampshire, up the road in Hanover, New Hampshire. There's an institution called Dartmouth College, and Ken French is an economist at Dartmouth College, and his way of looking at what's going on now is, and this is sort of a quote from him: "No one's spending money any longer on restaurants, travel, theater, clothes, and shoes. And bond yields are terrible. That's low interest rates. So stocks are the only place left to put your money." And that could be a reason why the stock market's gone up this year. So I think that, we can have a chat now about the economic outlook and all that. But, what I wanted to say is that if you're really thinking the stock market, which has done very well, much better than I forecast 9 years ago, if you're thinking it's really high, you might want to think again, because we may be in a new environment where interest rates are extremely low and therefore stocks are actually worth more. And, that may be what the stock market is telling us by staying up at these levels, even reaching new highs in the middle of a pandemic. So I think I will cut it off there and take some of your questions. I hope I've been a bit provocative.